Most people will work 40 years, save as hard as they can, and still run out of money before they run out of time. Not because they didn't earn enough, not because they weren't disciplined enough, but because nobody ever showed them the right way to invest it. Today, that changes. I'm going to show you exactly what I would do if I lost everything tomorrow and had to rebuild from zero, using 20+ years of value investing experience and the benefit of hindsight. No complicated strategies, no expensive advisors, no guessing. 3 ETFs. That's it. And if you follow this, you can realistically retire with millions of dollars, even if you're starting late, even if you feel completely lost, and even if you've never bought a single stock in your life. Stay with me because the numbers I'm going to show you at the end of this video genuinely changed how I think about money, and I've been doing this for over 2 decades. First, what's an ETF? An ETF, or exchange-traded fund, is basically a basket of stocks. Buy one ETF and you instantly own a tiny piece of hundreds of companies. That means instant diversification, low cost, and no guessing which stock to pick. Unlike mutual funds, ETFs trade in real time. And here's the kicker. They consistently outperform those expensive, actively managed funds run by people with Harvard MBAs. Warren Buffett himself has said the smartest thing most people can do is put their money in a low-cost S&P 500 index fund. And when asked what his family should do with his money after he's gone, same answer. S&P 500 ETFs. No tricks, no complexity. More investing activity almost always means less returns. The key is consistency.
ETF number 1, VOO, your foundation. The first ETF is VOO, Vanguard's S&P 500 ETF. This is the core of everything. VOO gives you ownership in the 500 largest publicly traded companies in the United States. We're talking Apple, Microsoft, Amazon, Google, Nvidia, household names that drive the global economy, but also less flashy companies like Johnson & Johnson, Procter & Gamble, Berkshire Hathaway, the kind of boring, durable businesses that just keep making money year after year. When you own VOO, you basically own a piece of the U.S. economy. If America grows, and over long periods of time it has always grown, your investment grows with it. The expense ratio on VOO is 0.03%. Just to put that in perspective, that's $3 per year on every $10,000 you invest. The average actively managed mutual fund charges somewhere between 1% and 2%. That's $100 to $200 on the same $10,000 every single year, and they still underperform. Over 30 or 40 years, that fee difference alone, forget about the performance gap, can cost you hundreds of thousands of dollars, maybe more. This is why I spend so much time on this channel talking about firing your financial planner. They're not bad people, but you're paying them for worse results. That's just math. Now, there are alternatives to VOO that are essentially identical. SPY from State Street is one of the most popular ETFs in the world. SPLG is another great option at a very similar price point to VOO. Honestly, the differences are minimal. Pick one and stick with it. The strategy for buying VOO is simple: dollar cost averaging. Pick an amount you can invest regularly, monthly, quarterly, whatever fits your life, and just keep buying regardless of what the market is doing. When prices are high, you buy a little less with your fixed amount. When prices drop, you automatically buy more. Over time, you capture the average return, which on the S&P 500 has historically been around 9 to 10% per year, annualized over long periods. That's your engine.
The ETF number 2 is SCHD, the Schwab U.S. Dividend Equity ETF. This one generates some debate, but I love what it does for a portfolio. SCHD focuses on companies with strong dividend histories, businesses that are financially healthy enough to consistently share profits with shareholders. We're talking PepsiCo, Coca-Cola, Cisco, Amgen, companies that have been around for decades, generate massive amounts of free cash flow, carry manageable debt, and reward investors through regular dividend payments. Right now, SCHD yields around 4%, so for every $10,000 you have invested, you're collecting roughly $400 a year just in dividends. And that income tends to grow over time as these companies increase their payouts. The expense ratio is 0.06%, so you're paying $6 a year per $10,000. The math there is pretty straightforward. You're collecting $400 and paying $6. That's a pretty good deal. In a tax-advantaged account like an IRA or 401k, those dividends compound without any immediate tax drag, which supercharges the long-term effect. Here's why SCHD matters to your portfolio beyond just the income. When markets get volatile, and they will, dividend-paying companies tend to hold up significantly better than high-growth tech names. Investors flock to stability when fear takes over. Companies like Coca-Cola aren't going to zero. People are still going to buy soda and snacks no matter what the economy does. That resilience is valuable. Now, I want to be honest with you about dividends because there's a lot of hype around them online. Dividends are not magic money. From a pure tax efficiency standpoint, they're actually not ideal. The company already paid corporate tax on those earnings, and then you pay income tax on the dividend when you receive it. That's double taxation. So don't make dividends your entire investing identity. But as one component of a diversified portfolio, particularly as you get older and want real income you can live on in retirement, SCHD earns its spot. That's why I own it. My portfolio isn't trying to maximize growth at all costs. I have other businesses and assets doing that. SCHD is there to generate reliable, growing income that I can eventually live off. If you're young and purely in accumulation mode, it might be a smaller slice of your pie, and that's completely fine. ETF number 3, QQQ, your growth engine. The third ETF is QQQ, which tracks the NASDAQ 100. This is where we crank up the growth. QQQ holds the 100 largest non-financial companies listed on the NASDAQ exchange, and it is heavily weighted toward technology. NVIDIA, Meta, Microsoft, Apple, Amazon, Tesla, Costco, the most innovative, highest growth companies in the world. These are businesses that can reinvest their cash at extremely high rates of return, which over time creates enormous compounding value. Here's a simple way to think about it. If Company A can generate a 10% return on every dollar they reinvest, and Company B can generate 30%, starting from the same place, Company B becomes many times larger over a decade or two. That's why high return on capital companies deserve a premium valuation, and that's why QQQ has historically outperformed the broader market. The expense ratio is 0.2%, still very cheap compared to mutual funds, though higher than VOO. The trade-off is access to these high-growth names. But I have to be straight with you about the risk here. QQQ is volatile. During the dot-com crash in 2000, it fell 80%. 80%. That is a gut punch that would make most people sell everything and never come back.
If you had bought QQQ at the absolute peak, the very top of the bubble in March 2000, right before it collapsed 80%, and you just held on through all of it, reinvested consistently, you would have earned roughly 14 to 14.5% annualized returns all the way to today. Think about that. Buying at the worst possible moment in modern market history and still crushing it. That's the power of not panicking and not trying to time the market. Downturns aren't disasters if you stay invested and keep buying. They're opportunities. I personally keep QQQ as a smaller portion of my portfolio. Not a third, more like a strategic slice. The volatility is real, and you have to be emotionally prepared for it. But for younger investors with a long time horizon, it can be a powerful accelerant. The numbers don't lie. Let me show you why this all matters so much in practical terms. Say you're 30 years old, you've got $100,000 saved, and you're adding $10,000 per year. Assuming a 9.5% annual return with low-cost ETFs, that's conservative, by age 65, you would have $6.6 million, enough to retire comfortably and still leave something behind. Now take that same person and put them in an actively managed mutual fund. They underperform by about 1% and charge another 1% in fees. Now you're at 7.5% returns. Run that same scenario, and suddenly you need to save nearly double per year just to hit the same retirement, and you still end up with only $4 million instead of $6.6 million. You'd also run out of money by age 83 instead of living comfortably into your 90s. That's a $2.6 million difference just from fees and average underperformance. That's not a rounding error, that's a life-changing amount of money. Now add 20% QQQ to your ETF mix, assuming it outperforms by about 4% per year, which is historically reasonable, and your projected retirement balance jumps to $8.17 million. Same starting point, same annual contributions, just a smarter allocation. And if you want to take it one step further, there's a strategy called covered calls. It's something I've been doing for 5 years, and it's something I genuinely wish I had started 20 years ago. You essentially rent out your ETF shares to generate additional monthly income, typically 1 to 4% more per year on your existing portfolio. Run those numbers through a retirement calculator, and that $8 million becomes $12 million. The same person, the same savings rate, just using their assets more efficiently. Here's what I want you to walk away with today. Building wealth is not complicated.
It does not require a financial advisor, a hot stock tip, or a PhD in economics. It requires three things: the right tools, consistency, and time. VOO gives you the foundation. SCHD gives you stability and income. QQQ gives you growth. Together, they cover the full spectrum of what a long-term wealth-building portfolio needs. Start where you are. Invest what you can. Keep going no matter what the market does. And if you want to go even deeper, learn how to pick individual stocks the right way based on real fundamentals instead of hype, click the next video. That's where this gets really interesting.